Are you looking to grow your wealth? Here's what you need to know about choosing the right mutual funds. Welcome back to FinsetWealth, where we keep saving, investing, and wealth building simple and real. Mutual funds can be an excellent way to diversify your portfolio and benefit from the expertise of seasoned fund managers. However, with thousands of options available and market trends constantly evolving, selecting the right fund can be a daunting task. Many investors struggle to make informed decisions, either overwhelmed by too much information or hindered by the lack of clear guidance. Add to that the uncertainty of market volatility, and the challenge only increases. Common pitfalls include underestimating the impact of fees, which can quietly erode long-term returns, or over-diversifying across too many funds, making it difficult to track and manage performance effectively. While staying informed through financial news is important, an overload of information can lead to analysis paralysis, where you end up making no decision at all. That's why it's critical to focus on funds with a strong historical track record, sound strategy, and consistent performance related to benchmark index. Mutual funds come in all shapes and sizes, from low-maintenance index funds that track the market to actively managed funds that aim to outperform it. While I personally advocate for index funds for their simplicity and long-term efficiency, many investors are still drawn to actively managed funds in search of potentially higher returns. But before I proceed with the analysis of some noteworthy actively managed mutual funds for 2025, I want to clarify that I am not a SEBI registered investment advisor. The content shared here is purely for informational purposes and should not be constituted as financial advice. Use this as a guide to help filter and evaluate mutual funds for your own investment goals. To ensure a systematic and meaningful comparison, I have focused on the following key parameters. Number 1, assets under management. Number 2, funds age. Number 3, expense ratio. Number 4, returns over a period of 5 years. Number 5, benchmarks return or category average. Number 6, Sharpe Ratio. Let's understand why these metrics matter. Just like market capitalization in stock investing, asset under management reflects the size and credibility of a mutual fund. A fund managing over 10,000 crore signals investor trust and the fund manager's ability to handle large pools of capital efficiently. So, I'm looking for a fund that is managing at least 10,000 crores. The longevity of a fund offers insight into its resilience. Funds that have been around for more than 10 years have likely weathered major market events such as COVID-19 crash, Russia-Ukraine war, and US-China trade tensions, etc. Longevity builds confidence in a fund's ability to handle future volatility. So I'm looking for a fund that is at least in existence for 10 years. Now, the most talked about parameters in mutual fund industries, the expense ratio. This is the annual fee charged by the fund house for managing your money. Even a difference of 0.35%, say between 1% and 0.65%, can cost you more than 10% of your final corpus over a period of 20 years. For actively managed funds, I have set an average expense ratio of around 0.75% as a reasonable threshold. So a fund that is charging close to 0.75% is fine for me. The first thing people check while selecting a mutual fund is the past returns. While past performance doesn't guarantee future success, it does offer a valuable context. I have considered a 5-year return threshold of 18% as a strong performance indicator. With consistent 18% returns, your capital can double every 4 years, potentially growing 32x in 20 years. That is what we call a 32-bagger. If you try to mix different mutual funds like large cap, mid cap, small cap, there is a possibility that you can get a return close to 18%. So 18% return is a good performance indicator. Now, checking the absolute return of the mutual fund can be misleading. Just 18% return by a mutual fund is good can be very, very misleading. So, it is wise to check the benchmark return or the category average of the fund is also important. For example, If a fund delivers 20% annually, but its benchmark returns or the average category return is 23%, then the fund is technically underperforming. Always compare fund returns with their benchmark to get the full picture. Well, there are different ratios in mutual fund industries, but personally, I consider Sharpe Ratio to be one of the most important. It measures risk-adjusted returns, essentially how much return you are earning per unit of risk. A Sharpe Ratio above 1 is desirable, indicating a well-compensated risk. For large cap funds, a slightly lower Sharpe Ratio may be acceptable due to their relatively lower volatility. So always try to take a fund whose Sharpe Ratio is 1 or more than 1. Here is a table comparing 4 funds that meet the specified parameters and demonstrate strong potential for future performance. However, selecting the right fund is only the first step. Once invested, it is essential to continuously monitor the fund's performance, especially since these are actively managed funds where human intervention plays a key role. While skilled fund managers aim to outperform the market, decisions can occasionally go wrong. If you prefer a more hands-off approach and wish to avoid the need for regular monitoring, consider investing in an index fund. Index-based funds are passively managed, track market benchmarks, and can be an effective long-term wealth-building strategy with lower cost and less complexity. In this analysis, I have primarily focused on mid-cap and large-cap funds, as it's not easier to apply these parameters meaningfully in these funds. However, you can use similar logic with some adjusted numbers for small cap funds as well. Again, these are not investment recommendations, but rather illustrations to help you understand the process of evaluating mutual funds. Before committing your hard-earned money for the long term, it's essential to do your due diligence. The world of mutual funds is rich with opportunity, but only for those who invest with clarity and discipline. By applying a structured set of criteria like the ones discussed above, you can significantly improve your chances of selecting a high-quality fund that aligns with your goals. If you have explored these or other mutual funds, I'd love to hear your thoughts in the comments. Don't forget to check out my other videos for more actionable tips and insights to help you save more, make smarter investment decisions, build wealth, and achieve financial independence. Like, share, and subscribe to FinsetWealth to stay updated on all things personal finance and investing.